All right. So the objective in this webinar, just broadly speaking, is going to be running through quickly the high level of what we're doing within the fund. And then we're going to get into a quick summary of what we have already bought, the progress that we've made on the business plans for the properties that we have bought. And then we'll start talking about the properties that we are under contract to acquire right now that we'll be closing shortly after we close this second round of funding. We recorded a webinar back in mid-June before we closed the first round of funding, which spends a lot of time. I believe that was about a 60-minute webinar diving into the fund, into the thesis, into the market, into some of the high-level conversation around underwriting and the acquisition criteria, a lot of team and track record conversation in that webinar as well. So if you do not know a single thing around what we're doing here in the the New Hampshire Multifamily Fund, I would actually recommend that you go back and give that one a watch as well. That said, I will discuss kind of the high level of what we're doing within the fund here as well, but we'll try not to be too repetitive for investors that are familiar with myself, with TJ, and then what we are doing here within the fund itself. But really, at a high level, uh, we created this fund to capitalize on the significant deal flow we have in the Aligned Real Estate Partners business. The very quick backstory on myself in the Aligned business is that really at a high level, I grew up in New Hampshire, been investing personally in New Hampshire since 2016, so coming up on 10 years here. And fundamentally, what we do really well, and if I were to describe what our core competency is as a real estate, group, is that we find a lot of direct to seller deals. We do a lot of direct to seller marketing and prospecting to get in touch with owners who are looking to sell their properties below market value for any number of reasons. Financial distress, operational distress, lifestyle change, just a desire to no longer be a landlord. We speak with a very large number of owners on a recurring basis around or about their properties, and we've been doing this for so long that we've really developed a robust pipeline of off-market deals, many of which are a little too small to buy on a one-off basis with investor capital. So for example, a 6-unit property, a 8-unit building, a 10-unit property are not really large enough deals on a one-off basis to raise capital for. And it's really for a couple of reasons. One is that the legal costs in terms of putting together compliant documents starts to significantly drag the deal level returns as they become a higher percentage of the purchase price for a given property. And then secondly, it's very challenging from an administrative standpoint as the sponsor to actually manage the all of the investor relations, all of the different investor groups, um, putting together the capital for each of these individual deals, drafting all the legal docs for a large number of these small deals on an annual basis, given that we do 10, 15, 20 a year, depending on the year. So we created this vehicle, this fund vehicle, to capitalize on the direct to seller deal flow that we generate, as well as the off-market deal flow that we generate through our extensive brokerage connections and our, just our investor relationships kind of throughout New Hampshire, and allows us to raise capital in this vehicle and then acquire properties as we source them over a 12-month period of time. And what we like to describe here as the real core fundamental thesis behind the fund is we are providing access to small multifamily properties that we're buying at discounts to market value to the LP, to our investors, which is not something that is readily available out there in the investment landscape from a private real estate placement standpoint. Now, as we progress here and we talk about some of the other benefits of actually investing in a fund structure, one of the other key attributes of this vehicle that you do not get when you invest in what we call a single asset syndication or a single asset deal is a level of diversification across multiple different properties, multiple different projects. And while we are laser focused within this fund in terms of buying properties in New Hampshire, we are providing diversification across different property types, or I should say property classes rather. So C class, B class, we may even buy some A class if the deal presents itself, but primarily C and B, but also throughout the geographic, region of southern and central New Hampshire. So we're talking multiple counties, multiple school districts, multiple cities, multiple towns. And What we feel that this does is gives investors a little bit more downside protection in the sense that their money is not tied to a specific deal and the potential risks of that specific deal, but rather spreads the risk across a number of deals within the fund itself. Obviously, I just mentioned how we are the fundamental thesis here is we're capitalizing on everything we do from a direct to seller acquisition standpoint. We've done 35 plus direct to seller deals in the last 3 years. And that, and this is specific to just the deals we've done direct to seller. And we've done a number of additional deals above and beyond this that have brokers attached, but many of those deals are brought to us directly by deep brokerage relationships in our marketplace because we have a track record of being able to close and a track record of being great to work with. And this is really the story of how we're finding deals. Now, the last thing I'll mention as well is that all of the properties that we are acquiring within the fund are either going to be vertically or managed by our vertically integrated management company, which is called Blue Door Living. Basically the Aligned Real Estate Partners Ownership Group, which is primarily myself, is a partner in Blue Door Living. I'm a founding member, founding partner of that business. And as a result, we experience some benefits from a pricing standpoint. And also, we just have more control over the management of our assets, right? We're not relying on a third party manager who we have no influence over, really no, just or no say in how they're operating their business, which again reduces the downside risk to investors given that we control the management platform. Now, we also have the ability to co-invest with other sponsors as well within the fund, and we're going to talk about a deal that we've already done with another sponsor, as well as another one that we are under contract to do when we start talking about the deals we're under contract on. And but the through line there is we're only going to be working with sponsors who are vertically integrated as well, right? That's a priority of who we are deciding to collaborate with and work with, is we want to own the management infrastructure within just the entire process here in terms of how we're actually taking down deals and operating them. Um, we spend a lot of time on the team. Back in webinar one, I just shared a lot about myself here, but I'll give TJ a quick little intro for those who are not familiar with TJ. TJ and I have worked together for a number of years now. I think it's been 5 years, and maybe I'm botching that timeline here a little bit, but probably plus minus a year if it hasn't been at least five. We've collaborated on a number of projects together. And we have a great working relationship over the projects that we've done, a lot of successful full cycle deals. Um, and up to this point, I think something that we're really proud of, and this is true for both of our businesses as well as the deals that we have co-sponsored. We haven't lost any investor capital, and above and beyond that, we haven't conducted any capital calls, any pref equity raises, any way that we could skirt around the true meaning of haven't lost investor capital up to this date, which is something that we're both proud of. TJ, I'll let you jump in here and share anything else that you want to add on top of that as well.
Yeah, I'd say, go back to the first webinar if you want the whole story on myself and Axel. But the most important thing here, like Axel said, is we've worked together across a number of deals, 5+ years, and much of my business started out in the capital raising sector. So I sort of had my pick of the litter in terms of operators I worked with, in terms of markets that I worked in, asset classes, and I invested across a number of different things. But I came back to buying multifamily in New Hampshire, and that's all we do in terms of multifamily now, and I don't see that changing anytime soon. And the reason is because the business here is just so unique. It's very difficult to, one, build this and compete with this and just plain find this anywhere else because most people are doing 100+ unit deals. There's a lot more competition for those deals. The sellers are much more sophisticated. Nobody's selling a property because they fell onto hard times with health issues or they're looking to retire. And it allows us to get much more attractive pricing while still managing this fund in a very professional manner. So I think that's all you really have to know from my end in terms of our working relationship and kind of how I got to join this fund.
Yeah, well, TJ mentioned some of the stories behind the deals we do, which I'll get into as well when we're starting when we or when we talk about the deals we're under contract on as well as the deals we've closed. Because I think a common question I get is like why would anybody sell their property to you direct to seller for a price that's less than market? You'll quickly find out in terms of like some of the stories that we have behind the deals that we do. Um, I spent a lot of time on the market in the first webinar, but some quick highlights for those that are unfamiliar with New Hampshire. New Hampshire is the only state in all of the Northeast US with positive population growth, and that includes all of its bordering states of Maine, Vermont, and Massachusetts, as well as heading farther south to New York, Connecticut, Rhode Island. Really, anything north of Virginia any state, I should say, north of Virginia has declining population growth, except for New Hampshire. Why is that? Very low cost of living state relative to, for example, Massachusetts, to its direct neighbor to the south. A lot of the properties we buy are within a 1 hour drive of Boston. So there is a large segment of our resident base that is either come from Massachusetts and is fleeing to a lower cost of living state, or they're moving to a state where there's no sales tax, no state income tax. Um, so that then leads to high rental demand. It leads to high demand on the single family housing side, where New Hampshire consistently leads, or I shouldn't say leads, but is in some of the market leaders for single family home appreciation year over year. Um, Same thing with occupancy rates being really low, rental demand being really high. From an owner standpoint, as a landlord, a property management company, as an investor, New Hampshire has favorable landlord tenant laws relative to the surrounding states. When you look at the direct neighbors of Maine, Vermont, and Massachusetts, New Hampshire is far more landlord friendly than those three states, as well as Connecticut, as well as Rhode Island, as well as New York, right? So there continues to be great demand from a capital market standpoint. A lot of lending interest, a lot of equity interest. Um, and again, there's continued interest in terms of the investor landscape from markets like Boston, where investors are fleeing the greater Boston area because of just what's becoming a very unpredictable regulatory environment around housing and bringing and coming up to New Hampshire. So we do have these tailwinds from an investment landscape standpoint as well. And then the big thing, right? We have this growth, but it's paired with minimal new supply. New Hampshire, similar to many, many markets throughout the country, had a spike in supply in 2020, 21, and 22 in terms of housing starts that are being completed right now. But outside of that, it was a very atypical jump in supply, and we are still a very supply constrained marketplace in general, where we are over 20,000 units short throughout the state of New Hampshire in terms of being at a housing equilibrium. So we have this growth, but we don't have this tailwind in supply because for rent development is still not that profitable for developers unless they're building ultra premium A class in just a very select few markets in the state. Um, and generally speaking, it's still a little bit harder to build in the Northeast, right? Comparatively to the Southeast, Southwest, Texas markets, where we have an abundance of land, very development friendly regulatory environments, and then all of the supply and job growth demographics that really drive more and more national developers to actually go there and develop housing. I'll quickly touch on the terms and the structure of the fund as well before we get to deals here. Um, We are offering a 7% preferred return for all of the funding rounds except for the first two. So the investors in Tranche 1 received an incentivized 9% pref. The investors who are investing before 10-1 are going to receive an 8% incentivized preferred return. And then there will be a 60/40 LPGP split above that. The only fees that we are charging as sponsors here are just 2% acquisition fees on the deals that we acquire. We're not charging any asset management fees, any disposition fees, any capital event fees. Something that I think is very important to note is that we're not buying deals with agency debt here. These are, typically the deals that we're buying are going to be too small to qualify for any agency. New Hampshire is not it can be a trickier market from an agency lending standpoint or a non-recourse debt standpoint, especially these small to mid-sized deals, as I mentioned. So TJ and I are personally guaranteeing all the debt. When we sign a loan with a bank or an alternative lender of some kinds, we're PGing that debt, we're personally guaranteeing that debt, and it's all full recourse. And we're not charging any fees for doing that. That's just part of what we feel we're bringing to the fund as values as sponsors here. Um, I spend a lot of time in first webinar here, but really this is the key here. Net to LP performance here in terms of our projected returns. We're projecting 7% plus cash on cash returns, 15 to 17% net IRRs to investors, and then net of fees, net of promote, with a nearly 2x equity multiple over the life of the fund. And with that being said, I think it makes sense to get into the deals that we have bought and to spend a little bit of time talking about what we are under contract to buy. And you see me skipping past a bunch of slides here that relate to track record, that relate to some more, information around timeline, et cetera. And we could always get into that at the end, but I'd like to talk about how these deals are performing. So, fund acquisition number one. We closed this deal back in early July, shortly after we closed our first round of funding. This was a 6 unit deal in Manchester, New Hampshire that was sourced direct to seller by our team. And again, quick little story around it. This deal was owned by an investor who had a few properties kind of throughout southern New Hampshire, a mom and pop owner. She had an extreme short-term liquidity need to go and pursue a piece of land out in the Midwest that she wanted to buy. Um, so short-term was the liquidity need for that, that she would only sell us the building if I personally lent her a an amount of money that allowed her to put a deposit down on this deal that I then secured with a second position mortgage under her first position debt that was going to be paid off at closing. Like that's how we got this deal was I was personally lending her the money, collateralizing it with a second position debt and closing the deal in a short period of time above and beyond that. Um, this was a deal that was occupied by a handful of housing tenants at significantly below market rents for what housing is willing to pay, both New Hampshire and Manchester housing authorities. And while we were under contract, we facilitated a housing or an increase to the housing vouchers that was quickly processed. So as of 7/1, even before we closed, we had brought rents from two of these units. One was at 1350, one was at 1400 to 1800 and 1810. And this is actually incorrect. It was actually effective July 1. Um, so before we even closed, we had already brought rents to above our pro forma for those respective units. And we've been, jumping into the business plan for the vacant units we acquired as well. So we took over with two vacants. Both are renovated. We've already leased one at our projected rent for that unit. The other one is live right now and we're receiving applications and interest in that unit. Um, but that is a typical story for the types of deals that we are buying within the fund.
Quick question here, Axel. So this is
Mhm.
from Tom, and we were actually talking about this the other day, but can you describe the Manchester Housing Authority? What is it? How does it play into, what we expect in rent? Is it more secure? Is it something like Section 8? What are your thoughts there?
Sure. So the Manchester, so basically to take one step back, so the housing authorities in New Hampshire operate a little interestingly. There's the New Hampshire Housing and Finance Authority, which has a voucher program that's good for any market in New Hampshire, right? Any city, any town. And they have a set of rents for each individual market that voucher is going to be good for. And then a lot of the individual larger cities in New Hampshire also have their own respective housing authorities. So in this building, we had a New Hampshire housing voucher tenant as well as a Manchester housing voucher tenant. And then Manchester Housing has a voucher program. Fundamentally, it's Section 8, right? I think it's more commonly known as Section 8 housing. But they provide vouchers to low-income tenants. Basically, what that looks like for us on our end is we have to deal with annual housing inspections. So they come in and do a safety and functionality inspection of the unit, make sure it's a safe place for a voucher tenant to live. Um, and then they sign a lease in conjunction with the residents. So they sign our standard lease, and we just operate with a 12-month lease program, or they can remain month to month if that lease expires. So we're not locked into any like long-term building-wide commitments or anything along those lines. It's just individual vouchers for individual residents who are occupying an individual unit at the property. And they send us rent on the first of every month. There's usually some type of split between what the housing authority is willing to pay and then what the tenant's co-payment is going to be. Usually a tenant's co-payment's anywhere from like 10% to 30% is like kind of the range that we see depending on what they're qualifying for from an assistance standpoint. So I believe at this building we have, these tenants co-payments are anywhere from 200 to $400 for these individual units. Um, and then they pay their portion, housing pays their portion. It's a pretty straightforward, seamless process. We have a great relationship with the housing authorities, given that we probably have 60, 70 housing tenants across our buildings kind of throughout Southern New Hampshire within our management portfolio. Um, we love working with housing authorities, and we screen those residents the same way we would anybody else, but the income piece is figured out, right? Clean background, clean eviction, clean criminal. We bring them in there. We still want to do a credit score check as well so that they can bring their co-invest portion, and it's pretty straightforward above and beyond that. Acquisition number two. So this was an interesting deal in that this was a deal that I owned with another partnership group and a partnership that went somewhat sideways that we had bought. We bought this property 4 months before the fund ended up buying it. The actual originating story behind this, though, because it does play into how we typically source deals. We bought a 6 unit deal from this seller way back in, I believe it was 2023, late 23. And it was a direct to seller deal. We sourced it through a mailer. The seller really liked how we conducted ourselves in that first transaction. And then they brought us the last deal they owned, which is this 8 unit deal up in Laconia for us to buy. We bought it with a partnership group that then, we dissolved, and it was sold to a partner of ours in this deal, Mammoth Properties, run by Sean LeBlanc. And it was still priced at a deal that allowed us to earn returns at the fund level that makes sense for our LPs. And since we've closed on it, we've actually identified some upside we didn't even realize was there. So there's a large 3 bedroom, 1.5 bath units on the property that we projected that we would get 1,900 for. We thought it was a little actually over rented at the time when we bought it. And we actually thought that, hey, if this moves out, we actually need to project a more conservative rent here. We identified an area in the basement that was already finished and that we can actually convert into another living space. And we're currently listed at $2,400 a month for that unit, which is, far exceeding our original projection. So this is a listed rent. If we get anything even close to this, that's a home run first step in this deal. And this is an example of a little bit more of a light value add deal where this building is physically in great condition. We're just taking the opportunity to turn units that were previously severely under rented by a very long-term owner who owed no money on it. Kind of the numbers here in regards to where the rents were and where we're taking them. And again, this is the story on a lot of our deals is a lot of these rents originally were in the $600 to $700 a unit range for apartments that should be leasing at $1,300 to $1,500 a month. So just not even close, and part of what we do is try to work with those legacy residents to get them closer to market. And as we do that, some of these units vacate, we turn them over, we lease at full market rent. And that tends to be the business plan for a lot of these deals. I noticed, Tom, you popped in there with a quick follow-up question on the housing side, so I'll address that too. If a tenant does not pay their portion, we work through an eviction process. Very rare that a tenant cannot come up with a few $100s a month, but it has happened. I'd be lying if I said it didn't. And we just work through a traditional eviction process in that respect and work to get that tenant either caught up or to turn that unit over. However, the risk of non-payment is very, very low with housing tenants because the last thing that a housing tenant wants to have happen is they have an eviction on their record, which disqualifies them from receiving any voucher assistance in the future. So they are very severely incentivized to make their portion of that payment because obviously nobody wants to lose their voucher. All right, progressing to the first deal that we have under contract here that will be closing in the next 30 days. This was a deal that was sourced direct to seller, a 5 unit property in Rochester, New Hampshire, which is a very working class town, C-class town out in the seacoast area of New Hampshire. 20 minutes from Dover, which is one of the fastest growing towns in New Hampshire, about 30 minutes from Portsmouth, which is arguably the most desirable city to live in New Hampshire. Certainly has the highest median rents and highest median home values. And perfect example of what we typically find from a direct to seller standpoint. This is owned by an owner who's owned this for multiple decades. He's ready to retire. He's ready to move. He's in his mid 70s. And the 3 units that are occupied at the property are they're rented at deep discounts to market value. We've got a 2 bedroom at 1,537. We have a 1 bed at 1,050. And he's working through the conversion of a commercial retail space to an apartment. which has already been approved by the city. He's already sprinkled the building. He's already done really all of the big stuff to go ahead and get that done. And all we're doing now is throwing up sheetrock, insulation sheetrock and framing, or I should say, finishes to fully complete that unit turn. And we're going to see some nice bumps on rents. And we're looking at a situation here where we're going to be creating significant value above and beyond our basis on this deal. And this is a very quick project too, which I think is the other thing that I'd like to highlight as well. When we're doing these smaller projects, we go from closing to basically stabilized property in a very short period of time, oftentimes on these smaller deals. We're going to be going in here, renovating the two vacant units, working through notices to the existing tenants to bring them closer to market rent. And if they elect to vacate and move elsewhere, then we can quickly renovate. And we'll basically be at or around our stabilized rent roll in 4 to 6 months on a deal like this, versus on a larger deal where, let's call it a 50 unit deal. That's typically a 2 year business plan, right? To really get all of those units to your stabilized rent roll. So part of this is that we can work quickly, we can work efficiently, which gets us to our exit on these deals a lot faster as well, which is not something I've not discussed yet, but I'll quickly touch on that. Is we have all types of optionality and flexibility with when we execute any type of capital event, whether that's refinancing the property and doing a cash out refinance, I should say, and returning some capital to investors. Maybe it's selling the property and actually taking the profits off the table and again making a return of capital to investors, or reinvesting those proceeds into other buildings within the portfolio and continuing to progress business plans. But because we execute, very quickly here and we bring these deals to stabilization very quickly, we have all kinds of optionality in regards to what we can actually do from a capital event standpoint as well. And this deal is a perfect example of that. Second deal that we have under contract, Pagewood Oval in Litchfield, New Hampshire. This is going to be a JV deal with Mammoth Properties, who I've already mentioned that we own a building with them within this portfolio up in Laconia, the 8 unit deal. We have done a large number of joint ventures with Mammoth Properties to date. This will be, I believe, our sixth joint venture with Mammoth Properties, at least myself. I know TJ has been involved in three others.
Four, maybe
Four.
four at this point, counting the
I think
Manchester Farmington deal.
that's right. Yeah. So,
Yeah.
TJ and I have worked with Sean and the team at Mammoth on 4 deals. I've personally worked with them in deals that TJ hasn't been involved with in six before this. A great operational team, vertically integrated from a management standpoint. All of the other deals that we've done with Sean and the Mammoth team have gone extremely well and are far exceeding projections. And this deal fits into the fund nicely in that it is a larger complex. In what is a true B plus class market in Litchfield, New Hampshire. This is a higher median income town, a higher median rent town, for example, than Manchester or Nashua or some of the other larger cities in New Hampshire where we're buying deals. Where we're going to be getting, the typical resident in a building like this is a 680 plus credit score type of resident who is earning 4x the monthly rent. A lot of these are renters by choice, not by necessity. And this deal is one where we can invest a chunk of the fund's capital into a more predictable cash flow oriented deal comparatively to some of the choppier cash flow deals. For example, like these smaller deals we're doing where over that first 4 to 6 month period of time, we're aggressively working through a business plan and turning over units that are not even close to rented at market rates. Whereas a building like this, we can implement a more organic business plan and bring these units closer to market rent without it being so choppy from a cash flow standpoint. So deals like this serve the overall landscape of the fund in that it's more recurring cash flow. It's a larger property where we're spreading our risk over a larger deal from a economies of scale standpoint, and we're partnering with a great operator in Sean and Mammoth that has a lot of experience with these types of deals. And the other properties that we own with Mammoth, excuse me, are primarily B class properties. And a lot of what we own and operate in-house with Blue Door Living is C class. So we're playing to our strengths from a management standpoint here as well, in that Not a world of difference between the two, but there is some level of subtlety in terms of the differences and nuance, I should say. So the very small, call it 2 to 20 unit management type of, or the management of 2 to 20 unit deals in C-class markets is something that we are extremely good at within Blue Door, and we're more than capable of managing something like this. But Sean and his team are really built to manage slightly larger complexes, call it 30 to 75 units that are B class in terms of their location and the residents that live in those units as well. Next deal we have in a contract is a 6 unit in Manchester, New Hampshire. Very similar to the story around the Laconia deal. We bought a 6 unit property from this seller 2 years ago. Um, Very easy deal. Sellers really liked working with us. So now they're looking to sell the last building they have, and they brought it to us direct to seller off market. So we did not compete with any other buyers on this deal. And we're under contract at a very compelling basis of 870K. Very, very few 6 unit properties in Manchester, New Hampshire have sold for under $1 million in the last 6 months. And the ones that have are in rough areas or are, significantly distressed from a CapEx standpoint. This is a beautiful building with a new roof, nicely vinyl sided. 4 of the 6 units have been renovated by the previous or by the current owner, I should say. And this is located in a true B class neighborhood in Manchester, surrounded by single family homes. There's no multifamily properties within a number of blocks of this building, outside of like a couple of duplexes that are probably owner occupied and nicer in condition. So this is a really nice buy this deal at a great basis. Turn over the units organically. Really, our work here is just going to be bringing some of these legacy residents to full market rents over a 3 6 month period of time. And if they decide to vacate, then we'll renovate and release. But a very straightforward deal that is really like the crux of what we typically are buying within the fund from a story standpoint. Direct to seller deal, previous owner selling because one of the partners who owns the deal is having health issues, and we've been in their ear for a number of years about it, and finally the timing worked out to where um, they actually came to us and wanted to sign a contract.
Yeah, I'll just add there too. If you're new to this to our businesses and you just stumbled upon this webinar, you're probably noticing a theme here on the types of deals that we buy. Many are bought at extremely favorable pricing. They're executed on a certain business plan. They all fit a certain profile. It's extremely boring, and from an investment standpoint, that's what we're going for. It's it's much harder to lose on deals like this when you're buying them at really good prices. Not only does that help us with the upside, but it helps us with the downside because if something changes, if the market corrects, because we bought them at such good prices, we still have optionality to sell, to refinance, to go into debt that we didn't plan on going into. And all these things help us as we navigate, as 6, 12 months into the fund.
Exactly. I'm going to quickly jump out of screen share here because I'm going to share some quick information here on the fourth deal we put into contract that has not even made it into the deck yet because we just put this one under. Tom, I noticed your question about debt, and I'll touch on this as I'm discussing this deal here. Um, but basically, what we just put under contract was a portfolio of 3 buildings, all located in Manchester, New Hampshire, in what I would define as C plus to B minus class neighborhoods, depending on the building. The story behind this deal was there was a 3 unit building on the market for sale with a broker that we have a long-term relationship with. And long story short, that deal went under contract at 675K, fell out of contract because the buyer had some financing issues. And again, very similar story, motivated seller who wants to sell. It was a seller who's looking to retire. They just sold their business. Now they're selling their 3 rental properties that they've owned for the last 5 to 7 years, depending on when they bought each of these 3 properties in the portfolio. And they're like, we're moving to Florida, we're selling everything. So the broker said, look, I know your number is probably not going to be around where this just fell out of contract, but just bring us your number. Um, and long story short, that was listed at 675. We brought our number of 585, and the seller accepted. Now, and that's for the 3 unit, right? And I'll talk about some of the reasons why. But I ran some comps last 4 months of sold properties or sold 3 units in similar neighborhoods in Manchester, New Hampshire, with similar square footage and similar bedroom counts, similar year built, etc. Average sales price here is 711, and that includes this deal here, which is a highly distressed deal. That is basically a foreclosure property that needs a significant amount of capex at 490. Um, so we're looking at a deal where we have all kinds of margin going in. Two of the other properties in that portfolio were duplexes that again were these are in Manchester. One of them was listed. It had just been listed by that owner, or by that broker, I should say, for that same owner. Listed at 535, I believe, and I believe our contract price on that is 465. And then the seller was like, we have our last duplex. We're about to list it. If we could just wrap it into this deal, that'd be great. We just want to sell them all to the same buyer and just be done. So we had an opportunity to tie that one up and put it under contract before it ever hit, the market in the MLS. Um, I'll run a contract for these duplexes between 450 and 470, I believe, for each of them. With again, these are sold comps. These are actual comps in like neighborhoods of similar square footage, similar year built over the last 4 months, showing us an average price of 608, right? So we have all types of margin on the buy with these deals. Now, part of that, and this now touches on, Tom, your question regarding debt structure. I'll highlight a few of these as we run through, but we typically are going to use a few different types of debt, and it's going to be dependent on the given deal, and it'll depend on what we need to offer from a term standpoint to get the deals closed and to actually be competitive and to secure these great prices. Ashland Street, we closed with local bank debt, Mascoma Bank, which is a bank that finances a lot of real estate in Maine, New Hampshire, Vermont. Technically a bank that's based in Vermont, but they've been aggressively lending in New Hampshire. A 6.5% rates, 75% of cost, basically standard terms outside of that. 30-year amortization period with a normal kind of step down prepayment structure. The Laconia deal was another local bank, technically a credit union, GFA credit union. Um, I think it was 80% LTV on this deal with a really compelling low sixes rate. I think we're at 6.3 on this one, but similar terms outside of that as well.
Yeah, no prepayment on that one too, I don't believe.
No prepayment, yeah, no prepayment at all, which is great. We had some interest only on that deal. 125 North Main Street in Rochester, as well as I should say, and again, it's not pictured because it's not in the deck, but this three pack that we're buying is going to be bought with alternative bridge debt. So we're going to be financing this with shorter term debt, slightly higher interest. This Rochester deal's a 9.25% rate, 12-month term with extension options, so we can kick it out past 12 months. But it's basically what's required for this deal, given that we have a little bit more capex. It's low in place rents. It's not as lendable for a local bank or credit union on something like this. And we'd rather have some renovation financing available for this deal. And fundamentally, it aligns with our business plan of we're going to be stabilized on this deal in 6 months, and we'll start the refinance process at that point in time to refi with a local bank or a credit union, which is what we're going to be doing with this three property portfolio as well. That rate, we have a loan product at just under 9%. It's technically 8.99, so we round up to 9% on that deal. But very similar, 12 months with an extension option. And part of the reason is that we secured such compelling pricing on this deal because of the fact that we were able to close quickly, right? The seller wanted to close quickly. We offered them a 30-day close, not enough time to do any traditional financing. So we're closing with alternative debt on that deal so that we can secure that great price. And then we just have the optionality to refinance out of that shortly after closing. So we're aligning the debt that we use with the business plan on the deal. And if we feel like we're getting a basis that's compelling enough to use some type of alternative financing, we may like to do so. Litchfield is a perfect example of this is a deal that we're going to finance with a local bank all day long. Mascoma Bank is going to be the lender on this deal at similar terms to what we secured on Ashland Street. 75% LTV, 6.5 rates, kind of a step down prepayment penalty that shaves off over the first 5 years, with some interest only on that deal as well.
Yeah, one thing to add there too is we've started to see rates sort of tick down a bit. I hesitate to say that because we don't plan the fund off of what's going to happen with interest rates. If we do see lower interest rates, the fund is going to do much better. That's just how real estate works. We'll see more buyers, and we'll be able to finance at better rates, and that'll increase the cash flow that we produce. Um, and again, that's not something that we really underwrite to, but at least for my seat, we're starting to see better interest rates, which means more cash flow.
Exactly. Yeah, so the very specific metric that many of the local banks and credit unions throughout New England and then, by extension in New Hampshire use is what's called the Federal Home Loan Bank of Boston rate. Um, for most of the summer, that was right around 4.25, and most banks price their rates as a premium over that rate, and they use it as their benchmark rate, usually anywhere from 200 to 250 over, depending on how aggressive a bank's willing to get in a particular deal. So for most of the summer, we're at like 6.5, 6.75, ticking up to 7, depending on if a bank was being aggressive or not. Now, as of today, I believe that rate was at 3.82. So, for a lot of the debt that we would start to source today on deals that we may go into contract on like right now, we'd probably be right around the high fives, low sixes. But that's lining up for great refis for a lot of the buildings that we're buying here, where if we can refine the lower rates with some of the deals that we're buying, with some alternative bridge debt, that's going to be helpful, right? And I think it's important to note that bridge debt gets such a bad rap because a lot of operators unfortunately put themselves in bad positions over the last 3, 4 years. But a lot of that was because they use floating rate bridge debt. One, we don't use floating rate, right? When we use a bridge debt product, it's a fixed rate. It doesn't, it's not going to change depending on what rates are doing. But also, two, we're doing it on much smaller deals. We can get to business plan stabilization again in a very short period of time. And this type of asset class is so well banked in New Hampshire, these small to mid-sized multifamily deals, that we have an abundance of takeout options when it ultimately comes time to get out of that debt. And again, it's not every deal, right? We're only going to do so opportunistically if we can secure great pricing with a shorter close. But most of the deals that we're doing are still financed with local banks. Devin had a question here. With cash out refis, you like the idea of funding additional property purchases, or do you prefer returning investor capital, and having properties finalized after the initial set is determined? It's a great question, and I think it's a little bit of a tricky one to answer, given that we have, a couple of competing incentives in a way. I shouldn't say incentives, but maybe a couple of competing dynamics where our goal as the sponsors is to return investor capital because that helps show a better IRR for investors, right? That helps de-risk the overall investment for our LPs, is to take quote unquote more of their chips off the table earlier in the hold period. It also helps to improve cash on cash returns when we're able to make some returns of capital earlier in the hold period. So fundamentally, that is our goal, right? That's our goal first and foremost. If we were to sell buildings, if we were to refi buildings, we want to return investor capital. That said, if there's an opportunity to reinvest the proceeds of a sale or a refi into what is a very compelling deal that meets our return expectations, it makes a lot of sense for our LPs. I think that's something that we will consider. And it's something that makes sense for us to consider, right? Because it is accretive to LPs to reinvest that capital in a tax advantage manner in deals that fundamentally make sense. That said, I think that early our goal is to return capital. Let's say that we, over the first 2 years of the life cycle of the fund, return all or a very large percentage of investor capital. And we are hypothetically in a position where investors have taken a lot of proceeds off the table, and we have the opportunity to refi a second time or start selling some assets. Maybe at that point, it makes sense for us to actually entertain the idea of reinvesting into additional properties or going longer on the business plans with deals that we've already bought. Maybe doing some key capex, maybe renovating like a final set of units, or optimizing the properties that are within the portfolio to a higher level. So that's how I would think about answering that from a thought process standpoint, Devin, and hopefully that's helpful. But TJ, do you have any additional thoughts there?
The the layer of having a fund also adds a little bit of complexity because we're raising money over four tranches, so four calls to investor capital. We'll have new investors come in towards the end of the fund, I'm sure. And we want to be very cognizant of making sure that we're equally fair to all investors, which is why we did the incentivized preferred return, which ends October 1st. We want to avoid the situation where we are refinancing immediately after that last tranche and then returning capital to investors that had just invested, right? So, we're going to pay attention to that. Um, I'm sure if there's an opportunity to refinance and roll that into a great property that we find through Alliance Deal Flow, we'll do that. But but yeah, those are some of the things that we're thinking about.
Exactly. Great timing on the question here around cost segregation, because that'll kind of round out our conversation here today. And then, Michael, I'll get to your question quickly right after that. Um, we are going to be doing cost segregation studies specifically on the buildings that have a high enough density to support the cost of doing that study just from a fundamental standpoint. Very broadly speaking, right, it makes a little bit less sense to conduct a cost segregation study on a 3-unit building, given the cost of the report as a higher percentage of the projected savings versus, for example, Pagewood Oval, which is a 30-unit deal. Um, that said, for a deal like Pagewood Oval, we will 100% be doing a cost segregation study. For the deal in Laconia, it's very like we'll be doing a cost segregation study on that deal. We have the optionality to do it on some of like the deals that kind of fall in the middle of the range I just described, like Avon Street, 6 units. Makes a little bit more sense to do one on a deal like that. And then above and beyond that, it makes sense for us to do these studies on deals where we have a longer term hold as part of the business plan. In the deals that we are more likely to be shorter term holds, and more transactional on, for example, like some of the duplexes, those are going to make a little bit less sense longer term from a hold standpoint, given that we'll have lower cash on cash returns. The highest and best use for those deals is typically to be sold to an owner occupant. If we can get into that deal and sell and earn a profit and a desirable return, we'll probably elect to sell those. And what we don't want to do is do a cost seg study on those and then pay back all that depreciation next year, in a couple of years. That said, we are certainly going to take advantage of 100% bonus appreciation, downstream from doing a cost seg study on these deals. We're projecting year one uh, losses, or I should say paper losses as a percentage of invested capital is a little over 60%. Um, and I think that's really the high level there. Anything to add there, TJ, that I missed?
So this topic is something that is a bit nuanced, and I'm sure you've had conversations with investors. I know I have. I would definitely talk with your tax professional on if you can utilize passive losses that are generated. For somebody like myself or Axel, it's extremely helpful. Let's say I invest 100,000 as an LP. I'll get a $60,000 tax write-off that I can use to offset other income sources. For many W-2 employees, if you're not married to a realtor or a property manager, it's a little bit harder to use that to your advantage. There are ways to do it. Maybe you have a sale of another passive asset that's generating a gain. You can use it to offset that. But again, I would talk with your CPA. I know I have investors who had no idea that they could invest in stuff like this and get a tax write-off. Think realtors, property managers, and it's just a nice cherry on top.
Yeah, well said. Michael, in terms of the question regarding term of loans, given the 5 to 7 year holds, when we are doing deals with local banks and credit unions, these are almost always, I don't want to, I'm always hesitant to use absolutes, but like 90+% of the time, 10-year termed loans that have either very minimal or no prepayment penalties incorporated. So credit unions, when we're doing deals with credit unions, just by virtue of being a credit union, we don't have prepayment penalties. When we're doing deals with local banks, we're usually negotiating down prepays. A lot of these banks will lead with like a 5 4 3 2 1 kind of step down structure where it's extremely prohibited to refi that loan in the first 2 years. We'll usually negotiate to like a 3 3 2 2 1 or a 3 2 2 2 1 so that we have the flexibility to get in and out of those loans. Um, that said, we are never doing a deal where we're going to have a prepayment penalty that's enforced on a sale. It's almost market standard here with a lot of the banks we work with to enforce prepayment penalties when paying off that loan and refining with another bank. But if it's a sale, we're typically not actually, those prepayment penalties aren't going to be enforced. So we do align our term and we're very, cognizant of structuring flexible prepays so that we're never a forced holder of a deal, which is something that I'm extremely concerned about when we're doing deals. Tom, great question as it relates to the joint venture with Mammoth here. So very broadly speaking, at a high level, if we are joint venturing with another operator, we are only doing so if we are an asset manager slash operator slash co-sponsor, all of that terminology being somewhat interchangeable on the deal, right? Where we have decision-making rights, we have voting control, etc. We're never going to passively invest with another sponsor in a deal where we do not have any influence over how that deal is executed and performs. So we are a co-manager of this deal, co-sponsor. TJ and I are both personally guaranteeing the debt, which I think is like the biggest example of like we are most definitely involved in this deal. Our personal balance sheets are on the line for the debt. And in terms of how the splits work, we're leveraging a very simplistic deal structure here where, for example, I'll use Church as one and then Pagewood as the other example. For Church, very simple structure where Mammoth contributed 20%, we contributed 80%. We co-sign the debt, we're co-sponsors. Proceeds, distributions, etc., are split 80-20, right? And it's just in accordance to the capital that's invested. For Pagewood, a slightly bigger deal. We have some other investors who are involved in this deal. And this deal has its own preferred return and split in regards to how the LPs are treated. We are the largest LP. We are 50%, a little bit over 50% of the equity in terms of what we're contributing to this deal. And the way to do this in a manner that actually makes sense economically for the fund is to have a proportional percentage of the general partnership at this deal. So basically, it filters down to what we would get if we were just a proportional partner in the overall entity with the other investors in the given deal. What's a little bit unique about this one is that we've negotiated a slightly higher percentage of the GP as a percentage of the comparatively to the capital that we've invested. So we're investing just over 50%, like I think it's 50.8% of the equity in the deal, $1 million on a total raise of 1.95. But we are receiving 57.5% of the general partnership. And what that mechanically looks like for the fund is the fund earns a project level return of in the low 20s IRR, which then filters down to the desired return for our LPs of that 15 to 17% IRR. In terms of what happens next, I kind of briefly touched on at the beginning. We're raising $4 to $6 million over the life of the fund. We've already raised over 1.6 in tranche one, which was more than we set out to raise. We were hoping to raise between 1 and 1.5. 1.5 was really going to be like the top end of our range, and we ended up exceeding that figure. We're capping this raise at 1.5 because we do not want to raise more capital than we're able to deploy. That protects LPs against a couple things, which is just capital downtime for their investment. But also, something that we're very sensitive of is we don't want to just have money that we're deploying for the sake of deploying capital, right? We only want to deploy capital into deals that make a ton of sense for our LPs. And we want to raise an amount of money that allows us to predictably put it out into the marketplace without having to chase deals that don't make sense or for capital to sit there while we're looking for those deals. So our goal on this round is to raise between 1 and 1.5, and we are hard capping it at 1.5. Minimum investment of 50K. All capital absolutely has to be in by 10/1. And a little bit of a nuance here that I want to suggest as well, because there is incentivized preferred returns or incentivized preferred return for the investors in this round, is that if you are an investor in a round with an incentivized pref, and this was part of the first webinar we did before the 7/1 close date, is that if you invest in a round with a higher pref, for example, this round, if you decide to invest additional capital in the future in future rounds, you'll be grandfathered into your original share class, right? So if you invest in this round, 8% pref, 60/40 split, even though future rounds will have a 7 pref and a 60/40 split, your investments will be grandfathered to the share class that you originally invested at. So if you like how things are going later this year, early next year, for example, and you want to invest again, you'll be in at your original share class. And if we have any investors who are current investors, I believe we do have a few on this call who invested in the first round. If you invest in this round, you'll be grandfathered into your nine pref share class. Uh, just to clear that up.
Yeah.
But that covers everything on my end here. TJ, anything on your end?
I'll just add that if you're somebody that's looking for that tax benefit, this 10-1 close will be the last round that will participate in the 2025 tax benefit. The next close will be 1-1. That will be for 2026. Um, and oh, in terms of timing for fund deployment. So I know I've been a part of funds where um, sometimes you invest and the money sits idle because the deal flow is not there, because the manager does not want to deploy into bad deals, which is a good thing, but you also want your money to be working for you. We'll be fully deployed with Tranche 1 right around October, first week of October, I believe, is when Litchfield's closing. And as of Tranche 2, if we raise $1 million for this one, the four deals we have will more than cover that. If we raise 1.5, we might have a little bit of capital left over. But important thing to note is that we will be fully deployed with the money that we raise in short order. Anything to add there, Axel?
No, I think that's a great note. And I think we are deploying tranche one a little faster than we even originally projected, which is great. So we had less downtime with those funds than we thought we would have when we actually closed that first round. Couple questions from Devin here, and then we'll probably get close to wrapping up. TJ, I'll let you touch on the second one here. How close are we to the 1.5 cap for this round? I know you've got some info on soft commits on your end. I can share
Yeah,
some
so
color on there, but
certainly. Yeah. I mean, just in terms of like how these rounds go, we're always raising money from busy people that have a lot of things going on in their life. They have kids, they have homes, they work jobs. So usually the life cycle of a tranche like this is you have conversations of I guess I can point to tranche one. Right now we're pacing with tranche one, about 500,000 in soft commitments, but it really starts to accelerate after we do the webinar. Once people have all the information, once they start to feel the deadline, there's about 2 weeks left here. And then with tranche one, we had, I'd say, 70% of the capital come in the last week. So
yeah.
um, really hard for us to say when we will hit that cap. We will be emailing out though along the way. If we get close to it, we'll make sure everybody knows.
Yep. And then in regards to the first question here from Devin, so in the future, do you expect new deals sponsored by both of you to be similar to this deal structure and less frequent than New Hampshire deals in the past? If I misinterpret this, certainly let me know. But at a high level, everything that TJ and I are buying in New Hampshire is going to fall within this fund structure here in the short term. The only types of deals that would fall outside of what we're buying within this fund would be an extremely large deal that requires a large amount of equity that would disproportionately invest a large percentage of the equity in the fund to that deal and skew the kind of the allocation a little bit, right? Something that we want to avoid is like over allocating to any one given deal because then we're a little bit more reliant upon that deal for the fund's performance and we're losing the diversification bonus a little bit as a downside protection component of what we're doing here. Um, so there is a chance that we find a 75 unit deal that needs, $5 million in equity or something like that. And that's a type of deal that fits a little bit outside of this fund, both in the size and also the thesis too, a little bit. Where like our thesis here is like high volume, smaller deals, like take advantage of our kind of discounted deal flow of inefficiently traded buildings. A larger deal falls outside of that a little bit. Um, but TJ and I both really view this as like our flagship kind of like multifamily offering to both of our bases of investors. So for the deals that we're finding in the aligned business, like we're taking into this fund outside of that kind of specialized circumstance that I just described.
Yeah, and to reiterate there too, this fund is getting first look at everything, if not the only look at the properties that are coming through the pipeline. And I think that's a really important point. Like, there's no competing interest there. Everything that Axel and his team have built up in terms of their deal flow, this fund is benefiting from.
Yeah, exactly. All right. I'm gonna go ahead and stop my screen share here. I think that summarizes it unless we have any other questions, but it looks like we are good to go. Appreciate everybody for hanging out on, pretty late here on a Monday night. And kind of, listening to us ramble here about some New Hampshire multifamily. Hopefully
Yeah,
we answered a lot of your questions. We're going to distribute this recording. If you're in TJ's sphere, I'm sure reach out to him if you'd like to schedule a call or have any. If you're in my sphere, reach out to me via text or email. I'm sure we'll be distributing the deal room link where you can download a copy of the OM that I was just running through, as well as the PPM and a lot of the legal docs, and running through the actual signing and funding process as well. But thanks for joining. TJ, anything to add to that?
nothing to add. Yeah, look out for some emails. We'll have video, we'll have podcast version of this, and there's tons of information in the data rooms.
Awesome. Thanks, guys.